Welcome. I'm Catherine Magana here with Rachel Ivanovich, Steve Wolf, and Vince Stefano, where we're here to provide you insights about the markets, taxes, and financial planning. Rachel and I are back from being gone last week. I celebrated a milestone birthday. I'm not going to tell you how old I am, but maybe you might be able to guess.
You look good for 100.
Thank you. But I think over the last week, I was just looking at where the markets were last week to this week. Obviously, we're down a little bit as of yesterday's close, but today the markets are up, so we'll probably be about even from last week to this week. And then I was actually looking back to 2 weeks ago when I was on the podcast last, and the numbers are pretty comparable, except for the NASDAQ stocks are down a little bit. But just giving you a recap of where we're at as of December 17th, the Dow Jones were up about 12.5%. The NASDAQ is up about 17.5%, and the S&P 500 were up about 14.28%, and the Russell 2000, which is the small cap stocks, were up about 11.75%. So still up for the year. Obviously, we have a little more time left between now and the end of the year, but I think it's looking pretty positive so far. Looking at where we're at with kind of some news, so obviously the big talk of the day is the November CPI came in.
Consumer Price Index.
Yes, which is the Consumer Price Index came in at 2.7%, which is a little lower than the last numbers, which we didn't see anything in October because of the shutdown, but in September, I think we were at about 3%.
But lower is good.
Yes, lower is good.
That means inflation is running at a lower pace than they thought.
The CPI represents inflation.
Exactly.
Yeah.
So that also gives the Fed some leeway if they want to do something with the interest rates.
And so speaking of interest rates, looking at the potential rate cut for January, right now it's a 26% probability, and the odds for March is 50%. But as Steve was alluding to, it's probably we may definitely see some changes between now and then. So we definitely know that there's going to be some potential rate cuts for next year.
Well, one thing we know for sure is there's going to be a new Fed chairman.
That is true.
Sometime between when does his term end?
May. His Powell's out in May.
Right.
But the new chair will be announced in January. And you know it's going to be someone who is going to be a rate cutter because Trump's not going to appoint someone to the Fed if he's not going to cut rates.
You know, I hope that whoever it is independent of Trump.
Well,
okay? Even though I believe that Trump has been right about as far as interest rates going down, you don't want somebody in that position who would just do what the president, no matter who it is,
no, that's
says.
true. You want an independent Fed, but you know, we'll see. We'll see. I think you'll get 2 to 3 rate cuts next year.
Okay, can we put that down along with your other predictions?
Absolutely.
Okay.
And then looking at where we're at with some of the short-term fixed income rates, right now the one-year CD is 3.75, so that really hasn't changed too much. But the one-year Treasury's come down a little bit. It's at 3.53, so the 1 year between CDs and Treasuries right now looks like the CD rates are a little bit higher than Treasuries.
So no one's really going to get rich on a Treasury bill or a CD.
That is correct. No. And then,
matter of fact, when you think about it, you can become poor on that because if you're making 3.5%, if inflation is running at 2.7, then you have taxes to pay. You could actually be negative with that.
And I've been saying that for a while.
You've been saying that your whole life.
I've been saying that for the last few podcasts, and I'll probably say it again. Anyway.
And then lastly, looking at mortgage rates, still pretty calm right now. They're 30 years about 6.05 and a 15 years 5.52. So not too much change over the last few weeks. But like I said, here we are. We're wrapping up, a couple more weeks left of the year, and obviously we're planning for next year and happy to do any reviews for you as needed.
Well, the other thing too, we always talk about each week. We talk about the CNN Fear and Greed Index, and currently it's at 46, which now is neutral. So neutral is 45 to 55. And we've seen, this has been a year where I don't remember seeing a year quite this volatile.
Like each week it seems like we've jumped a little bit.
Right. I mean, we've gone from I'm trying to remember now. I think we were up near 90, which is extreme greed, and all the way down to 6, which is about extreme fear. And now we're back in the middle. And that's all just, I think, since April. Yeah. So there's a lot of emotions that are going around. And actually, I think that's what's causing markets to be as volatile as they have been recently, What do you think, Vince? I know you're going to talk about that.
Well, I was going to mention that because, the last couple of weeks have been very difficult for my growth stocks. They've been hit pretty hard. And there's and when you think about it, I mean, it's kind of a generic sell-off. I mean, these stocks have had a great run. A little bit of the fluff has been taken out of these technology names. But when you kind of look deeper and you peel the onion back, a lot of the big hedge funds, and I'm not going to hit on hedge funds. I was a hedge fund manager at one time. I like hedge funds. But a lot of these guys, because of poor performance this year, are facing a lot of liquidations. And typically, a hedge fund needs 45 to 50 days of notice from their clients and investors for liquidation. So if they're going to liquidate at the end of the year, they get the letter sometime mid-January or mid-November.
Wait, when you're talking about liquidate, you mean they're liquidating their company?
They want to liquidate their investment position in the hedge fund. So they send a notice.
Oh, a client.
Yeah, a client or an investor sends a notice out saying, "Hey, I don't like your performance this year. I want my money back." You usually give 45 to 60 days notice. And typically, the hedge funds will wait until close to the end of the year because they want to see what the market does. Market started selling off, and I think there was probably some exacerbated selling. So that, I think, hit a little bit. And also, I think institutional managers, if they were taking any kind of profits over the last couple of weeks, that probably hit the market as well. And most of these big managers, the institutional guys, they're what, 80 to 90% of the trading on the exchanges these days, and they don't give a rip about taxes. They just want pure performance because that's what their clients want. So,
if we talk about taxes just for a second, it's my opinion anyway that there are people who would like to sell because they have huge gains and they're a little bit nervous about what's going on, but because of taxes. Now, they were talking about the retail client now.
Yeah, I'm not talking about the retail client.
No, I understand. Yeah. But because of taxes, I think they may wait until the first of the year. So it would not surprise me at all if the first of the year saw a dip in the market.
Well, that could be. And again, if that is the case, then, it could be a buy the dip type of mentality again. But, I've been saying 2026, I think, is going to be a pretty good year. I mean, when you think about all the things that are happening, and you've been talking about taxes and tax cuts, no tax on tips, no tax on Social Security, removing excessive business regulations. And one of the things that a lot of people don't talk about is the businesses can now write off capital expenditures completely in the first year, which is new and different for recently. Energy prices continue to decline. It's going to put more downside pressure on inflation, which is very, very good.
So gas prices are down everywhere except California.
Well, that's but that's California, and you know why that is. And
thank you, Governor Newsom.
And again, we were talking about this new Fed chair, and if we do get a cut in rates, and I think you'll see 2 or 3 times next year, you're going to see a downside pressure on money market rates, CD rates, and that's going to push people back into risk assets. Now, the big dilemma for investors that are in these CDs and money markets, do they want to stay there? Maybe not. But my suggestion to them is to look for interesting stock portfolios that may have above S&P 500 dividend yields. Now, we run those type of portfolios, so I just want to say to anybody out there who is thinking about moving out of CDs or money markets, come talk to us. We can we'd love to have a conversation with you about, these types of income portfolios. And finally, I just want to say one more thing because I know you're our dividend income guy. Mm-hmm. I just want to say one more thing. 2026, I think, for me especially, I want to look at companies and focus on those companies that have tremendous amount of innovation and creativity. And if management is correct, and management, they've been forecasting that the second half of 26 and into 27 they're going to see substantial returns on their AI investments. Now, if that's the case, I want to continue to focus on companies that have expanding market shares because of innovative products. And finally, I just want to say one more thing.
This is the second one more thing.
One more thing. I gotta say this because I was thinking about this the other day, and somebody was asking me about technology stocks and what I think about the stock market and, versus other forms of investments. And I just say, hey, listen, you don't want to be too conservative. You don't want to be too pessimistic because there are no bears on Park Avenue, only bulls and optimists.
Is that your last thing?
Yes, for now.
Actually, it kind of leads into something that I was going to talk about. And that is there's a fellow whose name is Rick Edelman. And he is a CFP. He's a financial advisor. He is an author and educator, writes books on finance and stuff. And he was saying that 60, the age of 60 is the new 30. And why is he saying that? And he's saying that because we are living longer. And the statistics are saying, according to this article, the statistics are saying that at least, well, let me.
That'd make me about 25 then, right?
Nice.
That puts me at 15.
I think I'm a toddler.
60's the new
Just kidding.
30. I love it.
Just kidding.
They talk about that today's newborns might live to be 100. Stanford says half will. And MIT's Age Lab says that today's 65-year-old couple has a 50% chance that one of them will live to at least age 95. So why am I talking about this? Because as financial advisors, if somebody comes in and they're 30 years old, for the most part, we might say, if you put everything in stock, you've got time to make it up. Not saying that that's what you do for everybody, but generally speaking, you've got a lot of time to make it up, okay, because you've got 40 or 50 more years, okay? The problem is right now, when you're 60, you still may have 30 or 40 more years.
Right.
All right? So you can't be too conservative. And I think that goes along really with what Vince is saying. Now, obviously, everybody has their own risk tolerance. Some people can't handle it, or, certain circumstances is different. But in general, we're looking maybe at 80-20 now, 80% stock, 20% bonds in a 60-year-old portfolio, in a person who's 60 years old. And the reason is because you don't want to run out of money. All right? And we were just talking about that. If you put everything in a CD and you're only getting 3%, and inflation is running at 2.7, and then you have to pay taxes, you are actually losing money. So over the long term, if you have 30 or 35 more years, that could be detrimental. Okay, it's not saying that everybody should do this. Obviously, we talk about this all the time. It depends on the individual person. But I think I think people need to really, really look at, where they are as far as their asset allocation. It used to be 60-40, 60% stock, 40% bonds. And that made sense, especially when bond prices kept going up because interest rates kept going down for the last 40 years. Well, that's not the case anymore. Bond prices have either leveled off or actually come down a bit. So, and where we're at right now, I think you said we're, 3-point-something% in treasuries?
3.75 in CDs and 3.5, about 3.5.
Right.
In
I mean, maybe we go down some
for 1 year.
But we're not going to go like where it was at 15% in 1986 when I first got in the business to where we are. It's going to be maybe 3.75 to maybe 3 or 2.5. That's not a big difference. So because of that, the bond part of your portfolio maybe should represent a little bit smaller. Again, doesn't mean there aren't other things to do. We talk a lot about alternative investments. We talk about other ways of getting income, but definitely growth should be and could be and maybe should be part of that portfolio in a greater degree.
So tying in kind of the overall financial planning picture that we usually look at with our clients is we factor in, are there pensions, are there social securities, is there rental income? Do you have an emergency fund? And then obviously then you have your money that's set aside for you, and then you have your money working for you. So to your point, yes, Steve, people are living longer. We want the money to last, definitely need some growth, but it is obviously case by case, and there's a lot of variables we consider. But I do think, once again, there's also the mix of, if it is an 80-20, what kind of 80-20 is it?
Right. Again, these are general ideas. Yeah. This isn't specific to anybody. Correct. But I can tell you that if you're not earning something versus inflation, if you're not plus after taxes and inflation, you are losing money. And when you're talking about somebody who's 60 or 65 and they're saying, well, I'm going to retire, and there's a good chance that they could live to be 90 or 95 or 100 because more people are, that portfolio needs to last. It won't last if you're too conservative. So that's all I'm saying. How you get there, the actual, the makeup of the portfolio as far as the actual investments is something else. But you got to make sure that you're not being too conservative. It is a major mistake that people make in retirement.
So Rachel and I have been dealing with a lot of clients this last couple of weeks, and we've been reviewing a lot of partial kind of Roth conversions and
The year-end tax moves. Yes. And I'm going to come right back to that, but I wanted to circle to a couple comments that Vince made just to make sure that our listeners are clear. I think you said something about Social Security not being taxable next year, and that didn't make it into the final bill. So Social Security is still taxed, unfortunately.
How about tips?
Tips, no tax on tips, but there are
overtime
and overtime.
So can we get our clients just to give us tips instead of paying us?
But I thought Social Security. I thought there was a
credit. There is a credit for seniors, so you have to be over 65.
Yes.
But it doesn't apply to everybody because if your income is over a certain dollar amount, and I think for single people it's $75,000, then the credit basically goes away.
Right, but there's still going to be some kind of credit on Social Security for someone.
It's not on Social Security. It's just
a tax.
It's not even a credit. It's a deduction.
Okay, I got you.
Yeah.
Right.
So I just want to make sure that people were not going, yay, I don't have to pay tax on my Social Security. And just on the capital expenditures, I think that's a really good point that you make, that it's called bonus depreciation, and they've talked a lot about it in the media. And bonus depreciation basically is if you own a business and you buy equipment, you can write off the full value of that equipment in the year, and that's going to be great for businesses. So I think that'll be great for stocks.
You get that immediate depreciation.
Correct. So you can write it off. So if you bought it in 2025 and you placed it in service in 2025, which means you started using it, then you can take a full write-off. And most states don't conform to that, meaning you don't get the big write-off for the state, so you make sure that you plan accordingly.
So this will be interesting because 26 is really the year where the policies kick in that were from the big, beautiful bill that the Trump administration has passed. So what you're saying is that at least some of it is certainly pro-business.
Oh, absolutely. There's quite a bit that's pro-business. The qualified business deduction, QBI deduction, qualified business deductions, basically 20% of whatever your profit is, you get to take as a business owner as an additional write-off on your taxes. And I think that they enacted this because the corporate tax rate was, I believe, 28% before the Tax Cuts and Jobs Act, and they cut it down to 21% flat tax. And so to make it equal for smaller businesses, they gave this additional deduction. And a small business can have revenue in excess of millions of dollars. So we're not talking small being $20,000 business or something, but it's a huge benefit for S corp owners, for people with sole proprietorships, with partnerships, LLCs, even people who own rental properties often are able to take the deduction, this qualified business income
So
deduction.
would you say that this bill should, since about 80% of businesses are small businesses, something like that, would you say that this is really beneficial for that, for the small business?
There were definitely some provisions that benefited small business.
Okay, because I know we talk about these bills, and we only seem to talk about the huge companies and how it affects them. But if and I don't know if this number is right, but I think it's close. 80% of businesses are small businesses. I want to know, how does that affect them? Because that really will affect the economy more than anything else.
But I think having that additional deduction as a business owner makes a huge difference on your taxes. And they also, I believe, made with the SALT. So the state and local tax deduction, it was capped to $10,000 under the Tax Cuts and Jobs Act. And under the One Big Beautiful Bill Act, they've bumped that up to $40,000. Depending on what your income level is, it can phase back down to $10,000 if you make more money. But the thing that is beneficial for businesses when it comes to that is there's something called the pass-through entity elective tax that you can. So basically, if you own a business, you can pay your state taxes through your corporation, and then you get a tax write-off for it on your personal, and you can use that payment to pay your state tax. So
the
super
accountants
tricky.
are never really going to go out of
I know, I
business.
was going to say, there's always a job for an accountant. But I'll
Wouldn't
tell
wouldn't it be nice if we just said, okay, everybody pays like 3% on anything they make,
great.
and that's it. We're done.
Oh yeah. So back to Roth conversions. So
We don't want to go in that rabbit hole.
not today, Steve. So Roth conversions, basically what that means is, and the reason that we do them, we'll get to that in a second, is if you have money sitting in an IRA and when you get to the required age, which now it's 73, it's going to be 75, depending on the year you were born, you have to take a certain amount out of your IRAs every year. And so what we're finding is that people have accumulated so much money that their required minimum distributions aren't so minimum. They're pretty large. And so we're comparing, what is that going to look like if they have that money accumulated, or does it make more sense now to take a portion of that money and convert it into a Roth IRA, which is a traditional IRA. You deducted, you put the money into the account, you took a deduction, or you had a 401k through your job and you got a tax write-off or a salary deferral of that, and that money is growing tax deferred. With a Roth, you put the money in and you don't get the deduction, but that grows tax deferred and comes out tax free. So a lot of people want to get money into a Roth, and there's all sorts of tricky rules about Roth IRAs that we're not going to go into today.
No, but one of the things I was thinking about is that doing a Roth conversion at an older age is a little bit more difficult, because if you're 2 years away from retiring or 3 years away from retiring, why would you want to pay all the tax at that point? Because when you convert, you have to pay tax on all those dollars.
Correct. Unless you have a year where your income is much lower, or you have a couple of years before you hit Medicare age, because if you do a conversion and your income bumps up over a certain dollar amount, let's just call it 106 for this year, your Medicare premiums you're going to get a little surcharge added or a penalty added to your Medicare premiums if your income is over a certain dollar amount. So, and Medicare, they calculate your premiums based on a 2-year look-back period. So when you're doing this conversion, you want to make sure that you're talking to us, because there are so many pitfalls along the way.
And we always hear everyone thinks, I should go do this. But the reality is it's not meant for everybody. But yes, it is a great planning.
Correct.
And for some situations, it definitely makes sense.
We've told
yes.
multiple clients and prospective clients recently not to do it because it didn't make sense for their overall picture. And that's why it's important to have a plan.
That's why it's important to come to see us.
Yes.
I'm even more bullish now about the stock market after what you just said about taxes. People are going to have more money to spend, and people are going to want to invest.
Well, I'm excited because we're going to change our fee base to just tips based.
That's true. There you go.
Then we don't have to pay any taxes.
No, I'm very optimistic.
And I'm
about
kidding.
next
Do you want me
for
to
those people
you want me to burst your bubble right now?
Why?
So you only get the no tax on tips for specific occupations.
Now do you want to
Your
know what
loopholes
those
are on.
occupations are?
I'll
But
print the list
that's
out
okay.
for you
I was
later.
so happy just 30 seconds ago.
Sorry, Steve.
Okay. All right. So what else we got going this week?
I think we're just kind of wrapping up between
The
now and
year.
the end of the year.
Tax
Just-
loss harvesting. It's so if you've got gains in your portfolio, we've talked to a lot of people about that though, and a lot of people say, "Well, I don't have any losses."
Yeah. That's the thing,
it's
that's the
funny
problem.
that we've talked to some clients and one client in particular saying, because we have sold some things for gains,
Yeah.
trying to be prudent, money managers, and they're saying, I can't believe I have to pay this much in tax. And I looked at them and I said, well, I can't believe you made that much in earnings. Okay, so, if you don't like paying taxes, then you need to get somebody in the Congress that will change that rule. Until then, that's the price of playing the game, correct?
There you go. The
Death and
stock market is a
know.
place to make a lot of money. So people, again, you can't be too conservative in the next couple of years. There's just too much going on that's going to have
Vince,
a positive
I don't think
effect.
you'll ever be too conservative because I don't think you've ever seen a bond that you like.
I don't like a bond. I don't like a CD. And hey, listen, I'm not a spring chicken anymore, but I must.
You're barely a fall chicken.
Hey,
But
60
I have-
is the new 30.
But I'll tell you, I guess my risk tolerance is just a little higher than a lot of other people's. But again, I think that the place to be is in very innovative companies, and I'm going to be looking for a lot of those for my clients next year and on into 2027.
It's funny you say that. We talk a lot about risk tolerance, and I think we need to talk about what is real risk. Risk itself isn't volatility, although part of that could be because if a sequence of returns could matter. But for the most part, risk is not volatility. Okay, risk is the chance of losing money. And if you have been in the S&P 500 or one of the indices that have been around forever, and you never sold have never sold anything out, you would have made a lot of money. So even though that during that time frame there were times when it went down by 30%, up by 40%, down by whatever, that's volatility. It's not risk. So that's something else I think that when they come to talk to us, that is something we need to make sure that every client understands.
And it's interesting, though, when the markets are down, so like the first quarter or April of this year, when the markets were down and the S&P was down a lot, clients get scared when the markets are down. And that's why it's important that we have a plan and we're diversified and we have different investments and we can explain, what's the purpose and why we're doing things. But when the markets are up and everyone's happy, when the markets go down, the emotions and the behavioral side, people get scared. And
they do, and I think that's because they equate volatility with risk.
But there's market movement and fluctuations, and that's part of investing.
Of course it is. But that's exactly what I'm talking about, that people do get scared. They do think, oh, my God, the world's coming to an end. I'm going to lose all my money. And in fact, again, if you have a well-diversified portfolio, that's not going to happen. Right. It just isn't, unless, I say this all the time, unless we become a completely socialist country, then it doesn't matter. Okay, but as long as capitalism is what we're doing, then I don't see that is a problem. And it's something that clients need to understand. So
we're here if you have any questions or if there's any other concerns, or obviously we're here to have those conversations with you along the way.
Right. So bottom line is, talk to us, call us, let us know what's going on. And let us know. Sometimes there are changes in your personal life, and we don't know about it because you didn't tell us about it, and we're not mind readers. We're also not mind readers to know necessarily if you're nervous. When those types of things happen, and I think it could happen in the beginning of the year. Again, if I'm right, that there's a lot of delayed people who are going to sell because they want to get that percentage that they own in certain stocks down. There could be the first week or two in January could be bad. Now, on the other hand, if what we're talking about, the big, beautiful bill or whatever, if some of those things are good for a business, then hopefully, Vince, you will be right that by the end of the year, it's going to be a good year. We will find out. In the meantime, we only have 2 more weeks left to go in this year, and it's been a pretty fun year for the most part. April was interesting, but for the most part, it's been really good. And for those clients who have thanked us for making money for them, we'd like to take all the credit, but when markets go up, it helps. So anyway, a couple weeks to go, and we'll be back next week, right?
Yes.
And
then we're off the last week.
Right. So we only have one more of these podcasts to go for the year, and maybe at that point, Vince will give us his idea of what he thinks is going to happen next year. Oh, I already know that.
You know what's going to happen next year.
All right. Anyway, thanks a lot for listening, and happy investing. We'll see you next week.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.